Hello students, I Prabha Sharma welcome you to the next ratio of the activity ratios called as trade payables turnover ratio. Sometimes it may be called as the creditors turnover ratio. Trade payable is equivalent to the total creditors and plus bill payables and the working capital's turnover ratio. These two ratios will be discussed. Trade payables turnover ratio shows the relationship between the net credit purchase and the average creditors or payables. Now you may see the trade payables turnover ratios is equivalent to net credit purchase upon average payable. If it is called as trade creditors turnover ratio, then the answer is net credit purchase upon average creditors. Average payable is the opening balance of the creditors plus bill payable called as payable, total trade payables, and the closing upon the creditors plus bill payable then divided by 2. Sometimes the students divide it 4. No, it is to be divided by 2. Opening plus closing 2 datas are there. After the calculating of this ratio, if the average payment period is needed to calculate, then if you want to calculate in days, then 365 or 366 days divided by the trade payables turnover ratio. Then answer will be in the days. The same is if the months are there, then 12 months or the then divided by the trade payables turnover ratio, then answer may be in the months. This ratio indicates the number of times the creditors are paid in a particular year. You may see here the one question is listed creditors turnover ratio. The formula is net credit purchase upon average trade payables. But you may see here the what is given credit purchase is given. So it means when the credit purchase is given, you don't have to calculate. The net credit purchase is automatically given. The opening creditors and the opening bill payable is given. Make the addition of the both to calculate the total trade payables. And the same is the closing data is given. So makes the total of the both creditors and bill payables. You may aware about the all these 4 items are to be added for calculating the average. But divided by 2, not by 4. So the answer is 3 lakh for the average trade payables and the 12 lakh upon 3 lakh is the ratio is 4 times. If you want to calculate the average payment period, then formula is 12 months. If it is in the months, 12 months upon 4 times, the answer is 3 months. So in the same manner, you may derive the ratios. The working capital's turnover ratios. Now I'm moving towards that it shows the relationship between the revenue from operations and the net working capitals. How will you calculate the total revenue from operation? It means it is equivalent to cash revenue plus credit revenue. Now, the working capital word is referring to the current assets minus current liabilities. You have to take this formula. Higher the ratio indicates the effective utilization of the resources and the resources are used in better way to the producing the goods. Thank you.